Well, just to introduce us, hello, stock pickers, money makers, wealth creators, along with my co-host Thomas Bennett. We are Beyond the Ticker, and I am Andrew Cox.
Welcome to our very first episode.
Yeah, episode 101.
We're both very excited to be here.
Yeah, I've always was told I had a good face for radio, so this is probably very similar.
Well, luckily I'm the only one that can see it.
Alrighty, how was your week anyway?
Yeah, it's been pretty busy this week, to be honest. We're going through a bit of custody transition with work.
Yep.
I'll just introduce that I'm an investment analyst.
Yep.
I've been working in this position for about 6 months now, and before that I was an investments officer. So the custody transition is a pretty big deal. We're moving from one bank to another bank. All our funds that are managed at work is moving across. And I've been real hands-on in that. And when our investment managers do trades, they settle days past. So it's usually T+4. So 4 days on, they settle. So we had to install a trading freeze for all our managers and just say, no more buying or selling stocks. Some of them didn't listen.
I was going to say, I already know the answer to this question, but did everyone obey?
No, they did not. So that's caused a lot of headaches for us. But we're ironing out the kinks now, but it's been a lot of late nights in the office and it's been a lot of fun. How's your week been?
Yeah, well, I mean, as you know, I'm, I guess to go back again, I work in financial markets as an FX dealer and I'm currently in between two firms. And so for the last 6 weeks, I've been on gardening leave. So, and for those of you that don't know what gardening leave is, that's just when you go to a competitor company, your current firm will essentially walk you out the door as soon as you hand in your resignation, and then, you basically sit at home and get paid until that non-compete period is done. So, looking forward to going back. I've had a bit of communication with my new firm, and so I'm starting in 2 weeks, and looking forward to that. So I've just been doing a lot of golf, trying to go to the gym, trying to avoid pubs, just really being able to, I guess, relax a little bit. Getting a little bit bored now, but that's what it is. So, it's been an interesting time in the market though. That's been interesting to be able to see and analyze how, just the overall market, some specific companies that we've looked at, and we'll touch on that later on in the podcast. But one of the items that we were talking about before, Tom, was actually inflation and how that's sort of, I guess globally is starting to impact, obviously from a central bank standpoint, different financial markets, obviously the dollars as well. I mean, working in financial markets, and inflation measure is quite a big indicator, and the expectation of what a central bank will do to reduce the inflation. I mean, like we were just talking about before, Tom mentioned we're at 40 to 30-year highs of inflation. So I guess what's your thought about the current situation we're in?
For those of you that don't know, inflation is the change in purchasing power of a general everyday consumer. So this affects everyone, and it's how much your dollar today will be worth tomorrow.
Yeah.
So for example, when you see the price of petrol go up, yesterday a dollar could have got you a litre back during the pandemic when it was under $1 a litre, but now a dollar barely gets you half a litre. So that's how it works. And we see 40-year high inflation in the US came in at 8.5% for March, which is astronomical. So prices are going up 8.5% year on year. We're seeing the same thing in the US. We're seeing the same thing globally. It's a bit of a trend moving forward. Experts are predicting that inflation is peaking or has peaked, but they've missed the targets quite a lot leading up to this.
Yeah.
The central banks were coming out and saying it was transitionary. Yeah. They were saying that we were moving through it and it wasn't going to affect the bottom line, but here we are, and it seems to be hanging on. So I'm more cautious than others in terms of trying to predict the peak of inflation.
It's certainly not something that I'm trying to, with me considering it with what's happening in the market, I know it's around, and I know it's probably around in different areas more so than what it's even been shown. And I guess to go back with regards to inflation and how it gets measured, they basically take a basket of goods, and that basket of goods does change, and it's for different areas, and it's basically just a measure, like Tom was talking about before, what it sort of costs to live your life, essentially. And so I just feel it, and that was the thing that you touched on earlier about the transitionary inflation. That was talked about a lot, where it wasn't, I never really thought I never really got bought into that because of just the amount of quantitative easing that central banks were doing. I thought it was a little bit, I don't want to say naive because they're not naive people that work in these places, but I feel like it was trying to, almost like an excuse.
I feel like they were trying to spread the narrative to us as consumers. They were saying it's going to be temporary, because as soon as inflation expectations rise, so too does inflation.
Yes.
It tends to follow. Because if you're expecting things to be higher, then you're going to pay the higher price. So it all flows through. So I think they were trying to manage expectations, but in doing so, they've completely missed this huge wave of inflation that's come through.
And so now where we stand with the level of inflation that we are at and the mechanisms or tools that central banks have to do, that's where I find it's going to be quite interesting, because different, like as we've seen last week or the week before, I think it was, the Bank of New Zealand raised their basis points by 50 basis points. The US, they did it by 25 the month before, and there's talk about potentially another 50 coming up. And you know, obviously during the COVID pandemic, they were cutting interest rates a lot to sort of stimulate funds and borrowing and just to try to keep the economies going. And now we're seeing a rapid increase to the other direction. And what that means is that borrowing funds and from a wholesale standpoint or investor standpoint is going to go up. There's going to be less capital, or businesses are going to probably not look at taking as much loans to invest into businesses. From a retail standpoint, mortgages will go up. So your disposable income as an individual essentially will reduce. Now, how aggressively they go to combat this high inflation level, it's going to be tricky, because you don't also want to skyrocket things where you make another market crash due to the rapid increase in cash rates. So I think it's look, I'm glad I'm not making the decision, but I think it's going to be a bumpy road for the next few months or next few years maybe.
Experts are predicting the first rate hike is going to be in June at the moment.
For Australia?
For Australia.
Yep.
And they're expecting 1.75% rate increase over the next year.
Yeah.
Which is quite phenomenal. And then you see that as well flow through the fixed interest market. This morning, the Australian 10-year bond, which is essentially what the government is going to pay for a bond out on 10 years.
Yep.
So you lend the money and then they'll give you a coupon every month. They'll pay you a percentage, and they will pay you 3% at the moment is what that 10 year is going for. So that means that the market thinks that rates will go up to 3% over the next 10 years. Hence, they'll get their value out of that.
Yeah. It's an interesting one, because the RBA have been so nonchalant with their reaction to inflation, and they've kicked the can down the road a lot, and we're talking about raising rates 2023, even 2024, I think initially. They were really not looking at inflation data. They said they were looking at employment numbers and other things, and I guess to their credit, they did say that they were going to look at it as a case-by-case scenario each time they meet and look at the data. But the initial increase expectations certainly have gone away quite a lot, I think, because we're certainly not going out of this year without a great increase in 2022. So this is more or less 2 years before their initial expectations to raise interest rates, and so it's going to be interesting. But it's I think property market will probably have a little bit of a hit. Certainly, we're sort of already seeing that now with the just the talk about them increasing rates. With such with the amount of capital that was available from the quantitative easing, coupled with the low interest rate, have sort of really put a fire under the market, the property market. And so I think that we'll probably see a little bit of a curve down the other way, in my personal opinion.
Where I'm living right now, I'm renting, but the owner of the house sent in some real estate agents to give a valuation of the property.
Yep.
So they came through a couple of weeks ago. They valued it at mid 500,000s. And so I think that just really shows the sentiment that people are expecting house prices to drop, and that now, they're kind of rushing to get in to get it sold and before the drop.
Certainly. I think from an investment standpoint or investor standpoint, that's something that is sort of been talked about and looked at as sort of kind of cashing your eggs out, I guess you could say. And it's, similar to the stock market. I mean, you and I, we have long conversations about what's happening on the market in general and specific firms. I mean, we've had a really excellent run over the last, 12 to 18 months. I mean, there was some of the firms that we got into that were done quite well out of. But, there's, a lot of chatter about how that's going to impact it. And, obviously one of the things when, cash rate will increase, where borrowing gets more expensive, firms like your tech firms or your early business growth firms are the ones that get impacted the most, just because they haven't got that, that real, they're not at the middle or the good part of their business cycle. They're still growing, so they still need capital, heavy capital requirements to build and grow and to sort of trend in the right direction from that standpoint.
A good example of that is the tech companies. That obviously they have a lot more debt on their books, so they've borrowed a lot more money. And they're very sensitive to these rate increases. Because that means they're going to be paying a lot more for that capital. And then that's obviously going to hit the bottom line. They're not even making a profit to begin with. So it's going to get quite difficult, and they're going to feel the pinch before the bigger companies like BHP, who are earning quite a substantial revenue every year.
Yeah, it's going to be... And I mean, we can then jump across to look at commodity prices and how that's sort of increased and what that's done to sort of, I guess Australia stock market's done quite well of it. Certainly the sort of iron ore firms have done quite positively on the back of that. I actually jumped into Silver Lake Resources probably 6 months ago now, and that's had not a bad little return just from the back of gold and silver prices going up, and more specifically gold. And so it's going to be interesting to see how that is sort of trends, I think, certainly this year.
Obviously commodities are at a record high. I'm going to ask you a bit of a prediction. I'm hesitant to give one myself, but obviously we see iron ore at a very high level, gold's at a very high level, nickel, copper, all very high levels. Are we expecting it to come down? Are we expecting is this the new normal?
I don't think it can be. I don't see it being sustainable. Do you know what I mean? Because I'm just thinking about the end user of raw material and whatnot and how that operates. If the prices stay too high for too long, it kind of does become the norm, and then everything gets more expensive as well. So say for example, the goods and brick and mortar or whatever it is that builds residential properties, and people that want to buy housing. All that cost will go up, and we've actually seen a pinch in the increases in costs and labour with some of the firms going bust over the last couple of weeks. So I would think that we're going to see a little bit of a soften of that. That's my prediction. I don't see that. I don't think we can stay here. That's me. But certainly, if there's more risk around the government, around the globe. Safe haven commodities like gold and silver will continue to stay quite strong. But that's my personal opinion. So I'm going to a real nice wishy-washy answer.
Yeah, wonderful. You're set for politics.
That's right. I guess the other thing I was going to jump on to is what's on your watch list at the moment. What firms are you looking at? What areas or are you looking at, or are you just sitting back and sort of seeing what happens? Like what are you currently seeing?
So I'm currently a little bit cautious. I'm not, trying to find every opportunity to throw my money in. I think now is as good a time than any to pick good companies. That will go through this. We could have some sideways movement. We could have a little bit of downwards movement within the market as a whole. So in those sorts of times, you want to find the good companies. So I'm pretty happy with how I'm positioned, but I do have one on my watch list, which is LGP. Little Green Pharmaceutical Company. Now, it's a little company that specializes in medicinal marijuana. It's currently trading downwards. So from a technical point of view,
it's not trending in the right direction.
It's not trending in the right direction.
But we like that. It means that the firm's getting cheaper.
It means there's an opportunity. So I'm not buying yet, but it is firmly on my watch list. And every week I rechart it and have a look and see what's happening. And it excites me that it keeps falling, because I think there's going to be an opportunity for a bargain there, because I do like what they're doing behind the scenes.
So Little Green Pharma, Western Australian-based company.
Yep.
They've got licenses in Australia. They've got licenses. They just got a new one. Was it in Europe or Italy? Did you say?
They got one in Italy.
They know they do some dealings in Canada, which is one of the biggest markets at the moment. It does look like an interesting company. I mean, this wouldn't be the first time. You and I have jumped into a falling company. Certainly, I've been trying to catch a falling knife, as you've put it. I guess I sort of bought it multiple different occasions and still continuing to sort of trickle away. That was AGL, obviously. We'll disclose that one. Little Green Pharma, that is an interesting one. It's something that's on my watch list as well.
It's a very interesting sector as well, because obviously about 2-3 years ago, there's a lot of hype. Everyone was getting into these medicinal marijuana companies. A lot of money's going in there, and there was really no profit at all from the sector, especially within Australia, where medicinal marijuana was only just becoming legal. And obviously, there's also a lot of growth potential worldwide. We see the medicinal marijuana increasing, and then as well, there's potential that we follow in the footsteps of other countries and legalize marijuana for recreational use.
Yeah.
And then these companies theoretically are at the forefront of growth already.
Yep.
So then they're gonna,
gangbusters.
Yeah.
I mean, if you're set up in a sector and then you've got the licenses in place and you're treading water, so to speak, and you get that green light, it's it's just a risk-reward standpoint, really. But it's like you said, you're spot on. And it's like a lot of things, I mean, we both work in financial markets, from an equity standpoint with yourself and FX with me. Markets are all over the place. Nothing really represents the value of firms. It's just an expectation to a certain extent. These companies get hyped up and everyone talks about it. And then, GameStop's an awesome one. So you get, people getting involved with it, and it's just about trying to get the price higher rather than what the company is. And we're firm believers of actually the underlying business. Buy the business, keep buying it over a long period of time, and reinvest dividends and reinvesting. So that's our sort of philosophy individually to how we invest. And whether the market's going up or whether the market's going down kind of doesn't really stop us to continually top up our holdings. It's just we'll probably look at slightly modifying the way that we're topping up our holdings, I guess you could say. It's a big opportunity, I think, with them, and it'll be interesting to see where they sort of fall. What are they priced at the moment? What was the price at the moment?
I'm not sure, but chips, absolute cheap as chips. That's what I'm saying. But I think they're going to fall a lot further.
Yeah.
I think now's a good time to remind the listeners that this is just two friends talking about what they're doing with their money.
Yep.
This is in no way financial advice.
Nope.
Seek a professional and licensed financial advice before you invest.
Yep. And do your own research.
Absolutely, do your own research.
I mean, if you do decide to listen to us and you start crying, just know we'll be crying in the corner with you.
Yeah. And we don't, despite our wonderful appearance, we do not know it all.
Exactly. This is exactly right.
So what's on your watch list?
Well, I've certainly got Little Green Pharma on my watch list. And I was looking at a lot of gold sectors, some silver companies. So I did pick up Silver Lake Resource, which is I've been quite happy with on the back of commodities. It was kind of towards the middle of or maybe even towards the later end of the commodity shift. But instead of just going and buying bullion, I wanted to try to find a good value firm in the industry. And
nothing wrong with getting on the upwards trends.
Yeah. So, I found them fundamentally. I felt like they were a good, strong business comparatively to the sector in Australia, and so I went down that path, and so that's one I've been watching. A couple of others that I've been watching as well is, I'm invested in them as well, but I guess you could say I'm always watching them, is FMG and AGL, one we discussed before. Man, FMG paid out a dividend 6 months ago. It was like 10% on a half year dividend. It was crazy. So I jumped on when I heard that news, and I was like, here we go. We had a little bit of a dip because there was a mass exodus of executives, but it's now back in the green. But they never cease to surprise me what they're doing.
They attract a lot of good talent as well. The deputy of the Reserve Bank, Guy Debelle, has just announced that he's leaving the Reserve Bank and he's going to Fortescue Future Industries Fund to work on the hydrogen project. So they've got a lot going on there, both in plain sight and behind the scenes.
Exactly. And Twiggy, or Andrew Forrest, as is officially known as, I guess you could say, unofficially, well, sort of officially, Twiggy. He's not scared to put a prediction down and put a deadline down for a project and have everybody sort of, I guess, to quote, good to great, have the bus going in the right direction with everybody on board. It might be a little bit of a chaos in the middle of it, and I'm sure if you're in the middle of it, it would feel like a washing machine. But he does seem to hit his deadline and his numbers. I think that's one of the things as well that we do look at with regards to investing in companies, is we do try to look at the personnel, the board, what they do, how educated they are, how much experience they have, and what their actions are indicating with regards to what they think the company's going to do. And Twiggy's somebody that you can certainly, I guess you could say, back that he's done it before and he'll do it again, I guess you could say. So it's going to be interesting to see how FFI goes and how their hydrogen project goes. But I know that they're sort of shaking up the industry with what they're trying to do.
Look, green steel is the future. Right. There's a lot. For those of you that don't know, coking coal is used to make steel. Iron ore. My apologies. So, it's a very carbon intensive industry. And then Twiggy Forrest has decided that he's going to make green steel. And not only just green steel, he's going to make it in Western Australia.
That's right.
Which is very exciting, both for Australia. It's very exciting for the world. It's very exciting for the environment. He's ticking a lot of boxes. Got a lot of good people involved. And for anyone who's ever been a part of a company, right? So my first job was in Woolworths. I did not know the board. Didn't know anyone. Didn't know anyone involved in the decision-making process. All that was just filtered down. So I feel like having someone like Twiggy so involved in the decision-making and such, a figurehead of Fortescue Metals, someone like real strong leadership and, obviously, quite a lot of key personnel on the board as well. I feel like when those decisions flow through to all levels of the organization, there's a lot of optimization that can be gained when everyone's moving their boots in the right direction. And when you have something that you can put up on the wall and say, we want to make green steel in Western Australia, and that's the vision, that's the goal, whole company's moving in that direction. It's quite powerful.
It is. You're absolutely right. And like you sort of touched on, the leadership, the history of them, the goals, what they're trying to implement, good for the environment, good for projects, good for, Western Australia and Australia. And he's always been a big supporter of, local stuff, like, R.M. Williams was a purchase that he made, the boot manufacturers and other areas that he's always sort of, he's always looking after, I guess, his neighbours, you could say, which is really good to have.
Notoriously good for the indigenous.
Massively good there as well. And I guess a good segue now across from FMG and the energy is AGL, which we talked about before, or touched on before a little bit. So this is another area that I've always been looking at, is actually energy, because they're doing obviously hydrogen and looking at different forms of green energy, and we've got such a large or a large growth area in electric vehicles. So I can, I'm kind of focused on energy and how that's going to transition from fossil fuels, and through to sort of your electric vehicles and your energy, I guess as a whole. So AGL, one that we thought we had the bottom, and we were 50% wrong.
Yeah.
And but we still continue to we still continue to invest, and we still hold. And they've got some really interesting things. The board announced that they were going to split into two different companies, one a grey energy company and one a green energy company.
Whether that will actually happen, we don't know.
We're still waiting to see if that will actually happen or not. And then this is we talked about predictions before, and I'm going to put it out there, but I can see this happening. I can certainly see it. I love to use the word synergies involved across the two businesses, but I see AGL Green merging with FMG FFI, and them creating the infrastructure that they've got with AGL and the network and clientele that FMG will promote from what they're doing with hydrogen, and they'll merge and all make one firm. It'll be a massive green energy firm with massive backing, massive exposure, and really good potential. So that's my stake in the ground.
Very interesting. And as we both know, a Canadian firm has recently put in a bid to buy AGL.
Yeah, that's right.
And there's a lot of red tape around that, because obviously there's a lot of foreign and domestic issues that come into play when you're thinking of a large foreign firm owning what is one of Australia's largest energy producer. A lot of havoc can be, come from that. Obviously, that's not their intention in purchasing AGL. They wanted to transition it to greener quicker.
Yeah.
So it's going to be interesting to see if the red tape that's involved in this will allow the stake in the ground that you've placed and the merger. I'm not a doubter. I too think that there's, two parties that both have a common goal, and there's a lot of synergy and a lot of potential gain from the merger. But it's a difficult one when you're talking about the largest energy.
Oh, absolutely. Yeah. That's why I kind of like to make the prediction, because I think it's
it's recorded now.
Quite bold. Yeah, we've got to get the stamp on it.
19th of April, 2022.
Yeah, that's it. You've heard it here first. Be on the ticker first. So there's some really exciting things happening. Certainly from merger standpoints, and there's a lot of firms have been acquired during this COVID period, and it's been the M&A area has just been exploding.
Yeah,
as you know. So there'll certainly be a couple of different patches crossed on top of companies, I'm sure we'll see on the back of this growth sector. So it'll be interesting to see who really grabs it with two hands, because it's good to see that businesses are focusing on it and making it profitable, because at the end of the day, we're investors. We want to see a return.
Yes.
So it needs to be profitable as well.
Of course. First rule of business is business.
Yeah, that's right. Yeah.
Both Andrew and I do have investments in AGL.
Yep.
I personally put in quite a big stake quite a while ago. And I'm not afraid to say that I'm still in negative territory for that investments. We saw a great company, a good balance sheet, good potential.
Awesome balance sheet.
Yeah, incredible balance sheet.
Well, we were talking about when we jumped into it, we're happy for a corporate raider to come and just sell the company, and we'll get paid, a lot more on our shares. The balance sheet is worth more than the shares.
Absolutely.
Market cap.
The value of assets that they hold is phenomenal, much bigger than the market cap. So we bought in. The shares have continued to fall until a point, probably, 3 or 4 months ago? There was a turning point. Yep. So it's now on its way up.
It is.
And I charted it again today.
It's a good looking chart.
It is a very good looking chart. You can go and have a look at our website, Beyond the Ticker. There is an AGL chart up there for you to have a look at and see what we can see. Yep. It's going upwards. That's what we like to see.
Oh, I'd love to see it. I mean, and this is what we were talking about before with regards to the way that we invest. We see a business and we look at their financials, we understand the business model, and then we put our capital behind it. And then the market is erratic. It's going to do what it's going to do. As the market was falling, I kept investing in AGL. So I've averaged down quite a lot. And then now it's on its way back up. I think it topped down about $5. Now we're at about $8 something, $8.80 maybe even today. So I'm actually in the green now with my. So I think about 8% up. We were in the red for a long time, and we're in the red for, by quite a lot. But it's a firm that we believe that it's going to do well over a period of time, and that's why we're investing in. AGL is a massive firm. The big ones have big stakes in things. They make big moves and big changes, and they grab big market share. So, and if worst case comes, someone picks it up and buys at corporate rate, and then I'll get paid out a premium on my shares, then so be it. But I think it's a good business, and it'll be around for a while.
So yeah, the last offer price was $8.50 a share, if I'm not mistaken.
Yeah.
So
Exactly.
it's looking pretty good. And we both think it's worth probably a little bit more than that.
Yeah. And we're not going to put any peaks on it by any means, but there's a bit of value that can be extracted out of the firm, we think, and it's great dividends, excellent dividends. It's always a positive.
That's true.
Excellent. Well,
it's a good place to leave it, I think. Thank you for tuning in to our first episode of the Beyond the Ticker podcast.
Thank you. Next week or next episode, we will look at actually Beyond the Ticker and what we do. We didn't actually discuss that in the intro. So episode 2, leave you on a cliffhanger.
Yeah, so much to get into. Thank you. Talk to you next week, Andrew.
Talk soon.